Missiles are flying through the Middle Eastern sky, and the fear of war with Iran swept over the markets that day. Bitcoin fell to the low $60,000 range and is currently rebounding, hovering in the low 70,000s. In the moment prices were crashing, some of you may have felt disappointed, thinking, Bitcoin really is useless fake digital gold in a crisis. When war breaks out, why does Bitcoin bleed first? If we only see this surface-level crash and leave the market, we may miss the true flow of money within the capitalist system. When an uncontrollable shock like war hits, the market's first reaction is not an elegant retreat to safe assets. It's an unconditional scramble for cash. When extreme fear sets in, investors sell off everything just to grab dollar cash. Financial markets were loaded with leveraged capital, other people's money stacked on top of your own. If asset prices shake even slightly, assets are force sold in domino liquidations just to repay debts. So why was Bitcoin the first victim? The answer lies in its structural characteristics. Stock markets close on weekends and at night, but Bitcoin trades 24 hours a day. When missiles flew on a weekend dawn and people needed cash by Monday morning, Bitcoin was the most immediately liquidatable asset worldwide. Its intrinsic value wasn't damaged. It simply played the role of a liquidity ATM, and that's why it suffered a short-term crash. We must remember one important fact from this first phase. War is not an event that immediately pumps Bitcoin. It is an event that, over time, shines an ever brighter light on Bitcoin's reason for existence. What gets priced in first is extreme fear and deleveraging. But once that shockwave passes, a completely different macro structure begins to emerge. When retaliatory strikes are reported and oil prices shoot past $80, $90, even $100 per barrel, Wall Street institutional investors aren't debating Bitcoin's philosophy. On their monitors, only one warning light is flashing. Risk limit exceeded. Big money operates with enormous leverage. When Middle East conflict threatens oil supplies, oil prices surge. When oil spikes, inflation rises again, and hopes for rate cuts are shattered. Higher borrowing costs mean the market mechanically starts cutting risk asset exposure. At this point, Bitcoin gets treated as risk asset number one in institutional portfolios, lumped with Nasdaq tech stocks. The market calculates tomorrow's interest costs and survival, not the future value of an asset. This is not because the Bitcoin network has failed. It is the cold, mechanical sequence of how massive capital manages risk within the capitalist system. The short-term decline in the early days of war is not Bitcoin's problem. It is the market's first process of digesting fear. But the real observation point is what comes next. When the conflict drags into a prolonged war, the one-dimensional emotion of fear slowly transforms into the very heavy reality of cost. Think about rushing a family member to the emergency room. At first, you tremble in fear, thinking only of life and death. But as the stay drags on, the mounting bills become the most terrifying reality. War at the national scale works by exactly the same mechanism. The US annual defense budget is approximately $900 billion. Every emergency security package for allies like Israel adds tens of billions more. On top of that, if war blocks Middle Eastern, oil supplies and prices skyrocket. Governments must pour out even more in subsidies and strategic reserves. War is fundamentally a process of burning enormous capital, but tax revenue is limited. So nations inevitably face pressure to take on massive debt. Smart money starts asking one cold question. Where will the government pull this enormous war cost from? And the moment that answer emerges, Bitcoin's risk asset label starts to change color. The answer is simple. There are only two options: raise taxes or go into debt. In a wartime economy, raising taxes triggers extreme backlash, so governments always choose the politically safe second option, issuing government bonds. When the US Treasury floods the market with trillions in bonds, it sucks up money in circulation like a black hole. Investors demand higher interest rates for the risk. Market rates spike, threatening the private economy, so the central bank steps in, creates new money, and buys up the government's debt. On the surface, it looks like monetary policy, But inside, it's the state printing money out of thin air to fund the war. Here lies the painful truth. Money printed to build factories or infrastructure leaves real value in the economy. But money spent on war is different. Expensive missiles are made, flown, and detonated without a trace. No real value remains, yet the amount of dollars in circulation grows enormously. Like adding plain water to a stew without adding more meat. The purchasing power of money is ruthlessly diluted. What gets priced into markets first is the fear missiles bring. But what lingers longer is the direction of money created by war's cost. War's astronomical invoice eventually returns as the erosion of purchasing power in our wallets. As government debt grows endlessly and monetary supply keeps expanding, smart capital feels a growing crisis. Holding paper money will see its value melt away. And just as the suspicion of the money printing state system blooms, another fatal weakness of centralized finance is exposed. Beyond the missiles in the sky, a more terrifying weapon operates. In the shadows, financial sanctions. In 2022, Western nations cut major Russian banks from SWIFT and froze approximately $300 billion in Russian central bank overseas assets in just days. Ordinary citizens in crisis zones suddenly find banking apps going dark, transfers blocked, and withdrawal limits cut to almost nothing. The bank account we use every day is not truly our own safe. It is a leased vault, where the state can flip the switch off at any time. That truth is ruthlessly exposed in the extreme circumstances of war. This is where Bitcoin's true logic begins to raise its head. The more the centralized financial system stiffens, the more powerfully Bitcoin's reason for existence shines. Bitcoin runs on a distributed network across tens of thousands of computers worldwide. No president, no authoritarian state has the power to freeze a Bitcoin wallet or block a cross-border transfer. This is called censorship-resistance. Smart money watching war drag on arrives at a cold realization. They must move the ownership of their assets outside the reach of national control. So as war deepens, Bitcoin is reevaluated as the only digital refuge that protects capital when the system breaks down. But one strong question remains. Why doesn't Bitcoin rise from the start? Like gold, why does it have to crash first? The answer lies in the weight of time. Gold has built 5,000 years of social consensus as the ultimate safe haven in crisis. When geopolitical risk hits, Wall Street algorithms mechanically buy gold, no questions asked. Bitcoin was born in 2009. It's a teenager. In institutional portfolios, its identity is split. Half digital gold and scarce alternative asset, half ultra-high-risk tech-adjacent asset. If gold is the battle-hardened elder everyone trusts first, Bitcoin is the brilliant, but still unproven 15-year-old. So on day one of war, Bitcoin absorbs the sell-off with stocks. But here lies Bitcoin's unique duality. It first takes a beating as a risk asset, then over time, changes its character to an alternative asset. Once the initial forced selling clears, the market regains composure. As war drags on and government debt grows, the structural fear of declining purchasing power creeps back. At this point, Bitcoin's absolute scarcity, a fixed supply of 21 million coins, rises to the surface and shines. Risk asset sellers fled on day one, but long-term capital, seeking to hedge against currency debasement, flows in to fill the void. The short-term crash and medium-term rebound are not contradiction. They are the natural time lag, as the market's perspective shifts from immediate fear to the cost of state money printing. The force that ultimately determines all assets is one thing: liquidity, the total amount of money circulating in the system. In the short term, rising oil prices reignite inflation fears, delay rate cuts, push up treasury yields, and strengthen the dollar. In this environment, Bitcoin and gold get crushed, but in the medium to long term, governments must endlessly issue bonds to fund war and central banks must eventually intervene to prevent fiscal collapse. That means more liquidity, and Bitcoin's logic revives. We've seen this before. In March 2020, when pandemic fear hit, Bitcoin crashed to $4,000 in days. The media declared it useless, but the US government printed trillions. Smart money flooded into Bitcoin, and it surged over 10 times within a year. The current war crisis has the same essential structure, only the name changed, from virus to war. The missile fear triggers mechanical sell-offs, but as war costs pile up, and governments print to pay for them, the second timeline, currency debasement, quietly begins to take shape. To summarize, when geopolitical crisis erupts, Bitcoin gets treated as a liquidity ATM and takes a short-term hit. But once fear subsides, the astronomical cost of war leads to debt expansion and money printing. In the early days of war, Bitcoin is suppressed like a risk asset, but as the centralized state system's limits are exposed, Bitcoin's existence as a scarce, censorship-resistant asset outside that system is powerfully reinforced. War is a short-term negative for Bitcoin's price, but over time, it shines an ever stronger light on Bitcoin's reason for existing. This has been Owl Bitcoin. If you enjoyed the video, likes and subscribes mean a great deal. Thank you.